course, we've seen retail sales numbers emerge here in South Africa, where April retail sales of 3.2% year-on-year has been clocked in. Joining me now is Sizwe Nxedlana, and of course he's with FNB Commercial Banking and a senior economist over on that end. Thanks so much, Sizwe, for joining us this afternoon. Well, we've got retail sales data reflecting this rapid increase from 3.2% year-on-year. Consensus was for 2.1%. What have you made of these numbers that have come in? Has it come in as a surprise?
Yes, it has come in as somewhat of a surprise. Consensus figures had expected slightly slower growth rates. There has been some noticeable revisions that have been conducted by Stats SA on the deflator of the retail sales figures, and that has also partly explained why we saw this upward surprise. But I think the trend is one of a gradual improvement in the retail sales figures. Another encouraging sign is not only the acceleration of the year-on-year growth, but also the increasing breadth of the underlying retail subcomponents. So we're starting to see more and more of over the last 3 months of the retail subcomponents beginning to also show signs of recovery, showing that this internal trade is becoming more entrenched and more widespread and gaining traction.
Let's take a look at where exactly money is being spent here, because we had Kees Bruggemans of FNB in on Monday unpacking consumer sentiment numbers, and he said quite glaring was the fact that consumers are still not showing confidence in spending on durable goods right now. So is that the trend that's persisting now, no matter what the sentiment is on the ground?
Well, there had been that trend. Case is correct in that the initial recovery was in non-durables, with the general dealers, food and beverage and pharmaceuticals being particularly a star performer. I mean, that would be in line with expectations. During the recessionary period, the necessities were relatively resilient, while the more interest rate sensitive components of aggregate demand had taken a particularly hard knock. We have seen a durable good component of the retail subsector beginning to improve. That's furniture and appliances. A laggard has been the residential building sector, and in retail how that's becoming manifest is via building materials. Yeah. So that is proving to be a laggard, and that would be in line with those consumer sentiment figures, which show that consumers overall are confident about the economy, about their own finances, but when it comes to now being a good time to make big financial commitments,
they're holding back.
There still is a little bit they are holding back. Yeah.
Well, let's take a look at then, because that's durable versus non-durable goods. So what about cash versus credit retailers? I mean, are credit retailers still feeling the brunt more so than their cash counterparts? Well,
if you look at some of the bellwether companies, that does seem to be the case somewhat. If you look at the furniture retailers, they are not recovering as strong. I mean, I listened to the Mr. Price results a couple of weeks ago, and they seem to be doing extremely well. If you do the comparison between, say, a Woolies and a Shoprite, it's the Shoprite and the Pick n Pay that are doing slightly better. And again, if you look at the actual credit figures, they are showing a very weak, in fact, contracting credit extension figures. So I would say, I mean, this picture does tie in with consumer confidence and with the fact that we're seeing contracting credit extension, with the fact that it's the more non-durable and semi-durables, the cash sensitive parts of retail that are doing better than the more interest rate sensitive parts of retail.
Moving forward, I mean, what are your expectations for retail sales number over this World Cup period specifically? I mean, looking at all the spending, not only from tourists, but from locals as well, who, despite our performance yesterday, are getting caught up in the hype. And we certainly saw today, I mean, also World Cup fever helping UK retail sales number in May as well.
No, looking forward, we expect this gradual uptick in the retail sales to continue. Obviously, in the short term, there will be a boost that will be added by the World Cup. But looking slightly longer term, we do think the recovery in retail and in internal trade in general will continue, because there are some important fundamental drivers of consumer spending that are beginning to heal. Inflation is moderating rapidly. On the goods side, inflation is sitting at about 3.5%. Interest rates are, at 30 odd year lows. Wealth effects, house prices are starting to show signs of life according to all indices, including our own. But there are also some very important speed bumps which make us think that it would only be a slow and gradual recovery. Those pertain to the upcoming administered price shocks that we're about to encounter. The fact that household indebtedness is near record highs, and again it's being manifested in low credit extension. And more importantly for me is the fact that jobs or unemployment is proving very sticky in a downward trajectory. We would expect unemployment to start coming down in line, lagging GDP growth, but it is still, there are some headwinds for overall consumer spending.
Well, given that that is the overall picture then, where we've got data starting to, demonstrate economic recovery and showing positively towards that direction, and we've got the realities of, things like indebtedness of households really coming under the spotlight as well. What's your outlook in terms of interest rates going forward? Because the picture looks pretty mixed at this stage of the game.
Well, I'm a big fan of listening to what the people that set monetary policy are saying. The Reserve Bank has hinted very strongly that it's unlikely to change monetary policy anytime soon. Or over and above that, in our assessment, there are certain key things that would have to come to the fore for us to change our view of flat interest rates, but for an extended period. Those would be, a rand possibly with a 6 in front of it. In fact, it's gone in the opposite direction. That would be economic growth that's slower, and we can see that the economy is starting to gain further traction. And that would be inflation outcomes that are lower than even the more benign inflation that's currently being predicted. So all of those things taken together would imply, even today's numbers, increasingly diminishing odds of further monetary policy easing.